Hey everyone, I'm Adam Bighill, your co-host alongside Petar Pejovic here at Pejovic Bighill Private Wealth. Peter, this is going to be a fun one. Our first one that we're recording, first of many, but as always, why don't you give everyone out there a quick idea of who we are and what we do?
Sure. Thanks, Adam. So, we are a well established wealth management team consisting of senior portfolio managers, qualified investment advisors, such as yourself, and financial planners, along with wealth professionals that have been in the business for almost 3 decades now. We're also with Wellington Altus Private Wealth in Canada and Wellington Altus USA, which manages over 40 billion in assets and happens to be the top ranked investment firm in Canada according to the Investment Executive magazine and is also Canada's fastest growing investment dealer. Now, in terms of who we serve, our clients hire us to professionally manage their money and are typically domiciled anywhere in Canada or the United States and consist of corporations, business owners, foundations, medical professionals, executives, and as well as professional athletes. Now, Adam, coincidentally, three of our members on our team are or were professional athletes themselves.
That's right.
What say to you about that?
Pretty unique. We are, I think, bring a unique, perspective to business from kind of our upbringing and what it's taken to become a professional athlete, and then take that into the business world. So I think that perspective is important.
Yeah. And that's going to be a bit of a side theme of our podcast as well, in terms of the playbook. And we're going to be talking about the playbook, kind of like in football, but we're going to try to relay that into investments and obviously global markets. So just a little bit more about maybe who we are. And maybe what we're maybe known for. So we're really well known for our thought leadership on global macroeconomic trends that matter, and also how that relates to generating profits for clients. And we're also known for our love of history and not becoming victim to what is called recency bias, which is a condition or a human condition where one believes that just because the world has looked a certain way in recent times, that the world will continue to look that way into the future, where very often it will not. And so that problem stems from not having a wide enough angle or time frame of history to incorporate events that, while may not have happened within one's lifetime or our lifetime, but nevertheless are significant and should not be ignored. Okay, so for this, history plays a key role and is a true strength, which we're going to be highlighting throughout our podcast. And we do all this through sophisticated modeling using artificial intelligence, technical, quantitative, and fundamental analysis, and by building multi-asset class portfolios, meaning that they don't hold just one asset class like stocks, but multiple asset classes. And that will be quite different from what you would see from a typical advisor or portfolio management team. So, Adam, to that, put it back to you and ask you, what do you want to talk about today?
Perfect. Well, I figured today, this episode really should be about the global monetary shift that is really happening right before our eyes.
Indeed.
Yeah, I mean, unmistakably, we're living in historic times, a compounding impact really of unconventional policy, radical innovation with AI, demographic shifts of baby boomers getting much older, and modern deal making from the presidential desk. It's rewriting every forecasting model out there.
Yes.
And to that end, I mean, I think we both agree that we believe markets are going to reward those who see the world as it is becoming, not as it was.
Exactly. Do not fall victim to recency bias, because things were a certain way and certain things worked a certain way. It doesn't mean that it's going to continue.
Yeah. And so to that main point, I mean, there's really been three major transformations of the global monetary system since 1871. And we believe we're entering into the fourth major change as we speak. And understanding this new shift is going to have a significant impact on people's wealth, and not necessarily all negatively, but differently, which is important because we're talking about playbooks here. The old
Yes.
playbook may not work nearly as well or even at all on a real basis.
We don't know. Nobody can know the future exactly, but history does indeed rhyme. So again, a lot of what we're going to be doing is going back to history and seeing what clues that might give us towards the future.
Yeah. So, stick around for the end because you'll be able to see a bit of what's in our playbook and how you can create a game plan for what comes ahead. So I think, before we talk about this new monetary system that's really unfolding, which is very, very important, we won't spend a lot of time there. I think it's prudent we just touch on the system that we've been in really since 1974 that directly relates to many of the current challenges that the U.S. is facing right now, which is at the heart of the major shift that's occurring right now. So maybe, Peter, jump in and talk about the petrodollar system and, maybe some of the main points of significance to get people's, mind around really what's happening right now.
Yeah. So again, tying it back to history and recency bias, if one had recency bias, most of their lifetime in this industry, or maybe as an investor, or just since you were born, many of us, we've lived most of our lives under this so-called petrodollar system. But what does that mean? How did it start? And oh, by the way, it does appear to be ending. So, which begs the question, what's going to replace it? And let's maybe go back to 1971 when President Richard Nixon ended dollar to gold convertibility. And that's where dollars could be exchanged for gold, something that we haven't been able to do for a very long time, but once upon a time we could. And when he did that, he made the dollar a pure fiat currency, meaning that what was once backed by gold is no longer backed by gold, and instead is pure fiat, which is ultimately vulnerable to inflation and loss of confidence as well. Now, this vulnerability was exacerbated by the 1973 Yom Kippur War, for those that remember that war, which prompted the organization of Arab petroleum exporting countries, which we now know as OPEC, led by Saudi Arabia, to impose an oil embargo on the U.S. and its allies from October of 73 to March of 74.
Yeah, Peter, why did they do that again?
Well, let's just say there was a lot of instability after Nixon closed, quote unquote, closed the gold window, which closed the window to convert dollars to gold. There was there's essentially a lot of turmoil in the economy.
Mm-hmm.
And then when that happens, whenever there's quote unquote a shakeup, different global powers will then, do things to try to, fight for a better deal in the new system, because that was a pivotal turning point to a new system, possibly much like where we're at today.
Right.
And of course, when you do things like quadruple the oil price from $3 to $12 per barrel, which is what happened at that time, people notice, countries notice, and it puts you in a position where you can negotiate a solution, which is essentially what happened.
Right. So you get this point where there's the Yom Kippur War, coalition of Arab states really versus Israel. The U.S. backs Israel, and therefore the embargo comes against the U.S.
And its allies.
Yeah, and its allies. Barrels of oil go up 4x. Inflation is a major problem, but it was painful for both sides, right?
Well, again, certain situations like that, nobody really wins.
Right.
Countries are just vying for or jockeying for position, basically, so they can get a seat at the table and negotiate terms to their favor. So, and that's kind of where we ended up. So, the U.S. sought to secure dollar dominance through energy markets and regain control of its domestic oil supply through negotiations, which occurred between U.S. Secretary of State Henry Kissinger, Treasury Secretary William Simon, and I'll try not to butcher this name, but Saudi King Faisal bin Abdulaziz Al Saud. So that's a mouthful. So then on June 8th of 1974, the U.S. and Saudi Arabia established the U.S.-Saudi Joint Commission on Economic Cooperation, which is an informal arrangement, kept secret actually until 2016, although everybody kind of knew about it. It just wasn't formally disclosed. Under which Saudi Arabia agreed to price and sell its oil exclusively, and that's the key word, exclusively in US dollars and no other currencies, and then invest proceeds. So obviously they would sell oil and take in dollars, so invest those proceeds, which are called surpluses, back into US assets. Much of which was U.S. treasuries or U.S. debt. And in exchange for this, the U.S. provided military protection, arms sales, and technical support. And that was a big deal and essentially helped begin to restabilize the system, which was destabilized in 1971 under Nixon.
Right. So we go from really essentially a gold-based system to a U.S. Treasury-based system,
And an oil-based system that
oil-based
supported it.
system on a U.S. dollar.
Yes. Yeah, which supported the dollar, because before that, I mean, the U.S. was the world's reserve currency and still was after this, but gold supported the dollar before that, and without the gold, something had to support the dollar, and essentially the gold was almost swapped for oil under an agreement with Saudi Arabia. And then by 1975, or thereafter, a year later, all OPEC members followed suit, which then formalized the petrodollar system. So, and which we had for decades and decades and decades. And once again, what did this do? This recycled oil revenues back to the United States, offsetting the inflationary effects of the gold window closure by Nixon, and then sustaining dollar demand despite the fiat shift. Now, Adam, how would they sustain dollar demand under this new system? Whereas before it was essentially started collapsing when the gold window was closed.
Yeah, I mean, every nation needs oil.
Yes,
And if you have to have oil if you're
Like
a developed
air.
nation. I mean, if you want air conditioning, you want means of transportation, you want a
Yeah,
comfortable
cars,
life,
buses,
you need oil, and therefore
plastics.
you need U.S. dollars. So this also affected these foreign nations who all of a sudden now needed to have U.S. dollars to pay for energy. How do you get U.S. dollars when you've never had U.S. dollars before? Well, you're going to have to print your own currency to buy U.S. dollars, and that in itself is inflationary in these foreign nations, right?
Mm-hmm. Hence, exporting inflation out of the U.S. to other countries, because no dollars means no oil. No oil means you can't drive, you can't do anything. You don't even have plastics. So really, it was an incredible idea in terms of doing this. And again, to be clear, when Arab oil nations sold oil in dollars, which is what they agreed to do, they would then take those dollars and invest them back into U.S. Treasury bonds. And what does that mean? It means the U.S. could issue debt almost ad nauseum,
Mm-hmm.
and countries that would be taking dollars in for oil, and other countries as well, would then buy those Treasury bonds and other U.S. assets. Which essentially means they were loaning money to the U.S. in return for interest and a promise to repay.
Yeah, and I think a picture, if you can just visualize literally like dollars just flying out of the United States, and just look at a
Yes.
map and just dollars flying everywhere, flooding every single country out there. That's literally what's happening.
Yeah. And now also, but because the U.S. can essentially issue debt, and that debt would by default be purchased, these loans allowed the U.S. to heavily invest in their military and economy. Hence, how they were actually able to create the juggernaut of a military that they have. And that's a function of something that they were able to do as a result of this system that not every country necessarily was able to do. And this obviously helped the U.S. maintain a strong military presence in the Middle East and globally, as well as see lots of capital flows into U.S. stocks, bonds, and other assets, creating essentially their dominant position, which has lasted for decades now.
Yeah, so maybe to unpack that a little bit more, strong dollar obviously started creating some major trade imbalances, correct? And that dollar is king stance, I mean, for the many good things that you've talked about, it had some real impacts back at home, making U.S. exports more expensive, imports cheaper. The U.S. consumer obviously, consumed, but exporting became a lot tougher with a stronger dollar, right? Our goods became less competitive in the U.S. and in global markets compared to those countries with weaker currencies, Japan, later China.
Yes.
And, a major impact if you're kind of looking at one of the cons, and there are a handful, impact on jobs and manufacturing.
Yes.
Right? I mean, from the 1970s to 2000s, industries like steel, textiles, electronics, had massive competition from cheaper foreign goods. And I think it's something like U.S. manufacturing employment peaked in 1979 at 19.5 million jobs, but by 2010 fell to 11.5 million. That's a 40% decline. And, you can really only explain that by what we just talked about.
Yeah, so there's a lot to unpack there, Adam. So if people just stop and think for a second, I mean, if the US dollar keeps going up in value because countries need to own and buy dollars with their currencies in order to buy oil, which they have to have.
Yeah,
Again,
once again, demand for dollars
yeah,
means
structural.
structural demand means, value goes up.
Value goes up over time. But so then you have the value of the dollar going up. How competitive does that make local US manufacturers? Well, again, if the dollar is up, that means other currencies have gone down. So what do you think happens to US Main Street, US manufacturing, when the domestic dollar is super strong, meaning it's very cheap to buy goods from overseas. But likewise, if you try to sell those goods in US dollars, those goods become very expensive.
So, Peter, you mentioned financialized economy, obviously with manufacturing taking a major backseat and really not as much emphasis. What was there to kind of fill in the slack, if you will?
Yeah. And actually, maybe before we go there, Adam, maybe you can just describe what is a financialized economy versus, say, a manufacturing-driven economy.
Yeah, I mean, you're really looking at, going from direct investment into maybe infrastructure or, assets that are producing, goods. You're going to things like banking and real estate. Or anything around those areas. It might be more speculative in nature around finance.
Yeah, so something's got to. So when manufacturing leaves, it basically creates a vacuum, and something has to fill that vacuum. So essentially, what we're talking about here is a shift away from a production-based economy where we garner wealth based on what we produce to a consumption-based economy where we're not really producing all that much, but we're consuming a lot, and the consumption then drives profits as opposed to production, which is currently, say, the type of economy that China has and Japan to a large extent as well. So if all we can't just sit there and do nothing but consume, we have to do something and make something. And if we're not making goods, then we divert our economy essentially towards what we just described as financialization. So that's investment diverted, from industrial sectors to more speculative activities like banking and real estate.
Right. And then many jobs were at the dismay of this change, right? So, the Rust Belt was hit pretty hard, places like Cleveland.
Yes.
Jobs are lost, and where do you go? What do you do? Is it a Walmart greeter, or is it sales? Is it car sales, insurance? I mean, you're going to, a whole different type of economy at that point.
Yeah, so we're almost a little bit guilty of this ourselves, right? Because other than playing professional sports, we're now part of this financial services sector, which even by the 1980s, which wasn't even that long past the closure of the gold window in 71, financial services accounted for a growing share of GDP, while manufacturing's share of the economy declined from 21% in 1970 to 11% in 2000. So it creates major changes, and it means I maybe go to university and we go into finance instead of becoming engineers.
Yeah, electrician, what have you, pipe fitter.
Yeah, and then the shift also reduced funding for factories, infrastructure, accelerating the offshoring of manufacturing to lower cost countries like Mexico and China, partly because they have cheap labor, but also partly because their currency is cheaper, and it just kind of started to make more sense to have them make stuff, with a much weaker currency than what we had. So, but of course, there's a cost to that. It's not free. Jobs followed, with millions of manufacturing roles lost to globalization. Yeah. So,
and maybe to that point, Peter. I mean, we talked about gold to start. Maybe throughout this system, and just an interesting fact, from 1971, gold goes from $42 an ounce into 1980. What does it go to? About $850.
Yeah, it was over $800 an ounce, probably around $850. Sounds about right.
Yeah. And maybe just hammer home the point there on fiat currency, and the shift of what the petrodollar system did with now the clean break from gold.
Yeah. So a lot of people may not fully realize this, but obviously the '70s were a massive bull market in gold as a result of the closing of the gold window in '71 by Nixon, and so essentially gold just kept going up and up and up, and it didn't really stop going up. Essentially, until almost a magic number was hit, and that magic number was uh, the um, the total U.S. debt that was held by foreigners needed to equal the total market value of gold that the U.S. was still holding to give the world essentially confidence that even though the dollar was not necessarily backed by gold anymore, that at the very least their debt in a more of a backwards roundabout way or backdoor way was still basically covered by gold. So what happened in the '70s essentially was gold went up and higher until such a point where that market value of gold that the U.S. still had not only equaled but exceeded the foreign holdings of U.S. debt, um, which essentially de facto gave it a backing and restored confidence.
Right. And at that point, could consider gold got itself into bubble territory,
Yes,
where,
absolutely.
there had to be a correction, as you mentioned, the statistic of, matching that of the foreign debt outstanding. And that's still something we're looking out for today. And guess what? We're not even close. And we'll talk about that in a bit. Um, and
No,
another,
actually,
and
I'll stop you there. Actually,
yeah,
there's some funny math. I mean, at least I was playing around with the calculator the other day. So I asked myself, okay, well, based on the amount of foreign debt that is out there, which I believe was something around $8.5 trillion of U.S. debt that was held by foreigners, and if the United States holds a little over 8,000 tons of gold, just some quick math. If you had a situation where the market value of the gold that the U.S. still holds, at least that we know of, anyways, equals $8.5 trillion, gold would have to rise to, and wait for this, $35,000 an ounce. So to your point, we're nowhere near.
yeah,
Like we're only 10% of the way there.
yeah, I was gonna say we're really in the first inning of a baseball game that is gonna go into OT.
Yeah, exactly. Yeah. Yeah.
Yeah.
So anybody who says that, oh, gold's expensive now, or you have to go back in history and measure how expensive gold became, say in 1980.
And maybe comparatively, and we'll do a show deeper in this as
Yeah,
well,
we should.
is when you're coming out of the before the petrodollar system, you have the Bretton Woods system where, gold was really suppressed in its price, relative to where fiat money was moving and money printing was moving. And you get this clean break from gold in 1971, which we'll talk about in a much deeper episode because it's extremely important as
Yes.
we even look forward.
It's fun
But
too.
yeah, it is. But
Yeah.
look how fast gold prices sniffed out where the market value needed to go, in really a decade. And one could say that we're close to a very similar setup here where gold price has really been suppressed. And we can talk about that through, the London paper gold system that, has been in place to keep
Yeah.
treasuries as the main game. But, we could be in a similar setup.
Yeah. And that's a long story, which again, could be a whole podcast episode in and of itself.
We'll get there.
But we'll probably get there. But again, just if gold was $42 an ounce in 1971 and it went to 850, I mean, you're literally talking 20x and above. Will history repeat or will it rhyme? Well, we don't know for sure, but we plan to be around to find out. That's for sure. So maybe kind of moving along, Adam. So do you think we covered that first part, well enough? And
Yeah, I think we hammered it, and we'll do something more specifically just on that topic. But for the main points today, I think we covered it.
Yeah, and it'd be actually kind of cool if any one of these little points that we covered off, quickly. You can almost do a whole like a learning episode on for any of people, not for maybe for everybody, but for those people that are interested in history and to get into some of the more nitty gritty fine details. Actually, just to wrap up the earlier parts. How we where are we today? Essentially, that petrodollar system that we just talked about is de facto ending for a couple of reasons. Well, number one, the Saudis in I believe it was June of last year in 2024, did not renew the arrangement for the first time and obviously in decades. So, that says a lot right there. But even before that, it's been a few years now where some countries, not all countries, but some countries certainly were able to buy oil in other currencies other than dollars, namely China. So for a few years now, in Shanghai, you can buy um, oil in yuan. And keeping in mind that wars were started in years prior in certain countries, where that was attempted. But again, China's a different story. So now the landscape is shifting. And the U.S. has some problems, which they, of course, aim to solve. So, Adam, why don't you just highlight some of the major problems the U.S. is currently facing?
Yeah, and maybe I'll just start with the fiscal problems. Is they're pretty undeniable, and I actually have some
Slides.
charts to some charts to show everybody that I often find that words and pictures going together are pretty powerful. As you see right now, right? This is the U.S. Treasury website where you can pull a lot of this data. This is actually from 2024 September, so it's a little bit out of date. We know that now the U.S. national debt is around $37 trillion.
Yes.
And, this graph
And
says a
growing.
lot. Yeah, and growing. If you just look at this graph, it doesn't look linear, does it? It looks pretty exponential. That's a problem. If I go to this screen right here, this depicts, national debt or global debt. Who's got the biggest chunk? It's pretty easy to see. That's United States. And this, once again, was in 2024, where this number is going to be a little bit higher now. But certainly United States with the largest share of global debt, followed by, if you're looking China, Japan, at 2.3%. Once again, that's a problem. You're the leader in global debt. Maybe, and more importantly here, as we go to another chart, is basically near the largest debt to GDP ratio in history. Basically, what we're looking at is debt you have to the economic prosperity and output that you're producing at any given time. You can kind of see where we were in the 1940s, post World War II. I highlighted a few points on here, Peter. Maybe just touch on the red dots. I mean, these are important points in history, just quickly.
Yeah. So, and if this chart went back even further, that line to the left might even be a bit higher. I do believe, going out of the Great Depression and then going into World War II, obviously the United States had lots of debt. I mean, they had to fight a major war, as did other countries. And not only that, Europe had to be rebuilt, as did Japan. So lots of money had to be printed, essentially, or created, and it had to be spent, which created a lot of debt. And coincidentally, actually, late 40s, early 50s, they had a lot of the same problems that we have today, and they did have to find ways to bring that debt to GDP ratio down. And again, probably a topic for another podcast, but they used terms like economic repression, say, for example, where they essentially kept real interest rates low and in fact negative during that time, to essentially try to reduce that debt to GDP ratio to a more palatable level. And that does not happen overnight, but it did work. As you can see there, going from the late 40s through the 50s and the 60s and into the 70s, debt to GDP did come down, dramatically. Now, of course, we also, at the Cold War and Volcker shock, right around 1980, we had, what do we have? How high were interest rates, Adam?
Yeah, I mean, I know the U.S. Treasury was paying 15%.
Yeah. So think of it this way: it's almost it almost had to, that line there had to come down, because could you imagine if the debt to GDP ratio was as high as it was, say, in 1950, down to 1980, when interest rates were, let's call it 20%? It just wouldn't have worked. The only way the system essentially survived 20% rates was, at least we had low levels of debt at that time. So, and then of course, think of it this way. So if we have if rates max out at 20% and they started to come down, when we have falling interest rates like we had from 1980 onwards, Adam, what does that do to the real estate market?
Well, people start getting pretty antsy to buy something.
Sure, because their payments get what?
Yeah, I mean,
they get cheaper.
Get quite cheap. And I mean, if we want to just bring it to today's era, I mean, that was COVID. near zero interest rates. I mean, so many people were bragging on, I got a 1.99% interest rate, right?
Mhm. Yeah. So falling interest rates typically, at least historically, has the effect of having what effect on the demand for loans. So how much people are seeking loans, and
Yeah, I mean, basically
goes up.
inversely related, right?
Yeah.
Rates down, economic activity, and specifically loan creation going up.
Yeah. Yeah. So loan creation goes up, and as loan creation goes up, financial assets also go up. Real estate goes up, stocks goes up, and then you get what? You get the dot-com bubble.
That's right.
Essentially, there's just there was all of a sudden a demand for leverage and taking out loans that just simply wasn't there in 1980 when rates were 20%. But when rates fall to 5 or 6, all of a sudden borrowing money doesn't seem so bad.
And this is where you get
No.
the idea of cycles, right? You have the high interest rate cycle, the low interest rate cycle, the Fed trying to curb spending or trying to incentivize growth back in the economy. Certain times, they make it very hard for you to borrow money, start a business, to expand your business, grow your revenue. And then at other points, make it very, very easy and almost try to give you free money to be able to create more employment, trying to avoid recessions. And these are cyclical in nature. And, we can kind of see what happens when you get near the end of a cycle.
Hmm. Yeah, because a lot of that actually sounds like a good thing, and I think many people might look at that as a good thing. I mean, who didn't like it when initially, at least, when they buy a house and all of a sudden they'd end up making a lot of money on their house because more and more people took up more debt. More debt means more money is chasing the same homes, and the house price goes up. But what do you think, Adam? Is there such a thing as too much of a good thing?
Always, if you drink enough water, it'll kill you.
That's right. Yeah, I'm going to drink some
So
water
yeah,
right now.
absolutely.
Yeah. So too much of a good thing, right? I mean, just too much money printed. It's all chasing housing. You're getting people that have, call it normal average type jobs, that own 2 houses, 3 houses, 4 houses, all on debt, all speculative. A lot of it with zero down and very weak credit applications. And then what happens? You get the great financial crisis. You get what happened then, essentially,
Yeah.
in the U.S. to real estate.
Yeah, just got utterly nuked.
Yeah,
And
that bubble was popped. Like, it was just a big fat balloon and just pinned and boom.
which, as we talked about, coincided with pretty large manufacturing job loss, right?
Yes.
We already talked about that, right? So
Yeah.
just to bring it back to that, where you create these problems.
Yeah. Yeah. And actually, the job loss is accelerating. I mean, they started obviously, in earnest, probably late 70s, early 80s, but then they seriously accelerated post .com bubble in 2000, and then right through the financial crisis. So, and then what happens? There was a bit of a stabilization effort, and then as you can see here, debt to GDP continues to climb. And in a financialized economy, so maybe we'll go back to there for a sec. In a financialized economy, essentially, how do you grow? Like, how do you grow in a financialized economy? And basically, then again, what we were talking about earlier, it's not about production. It's not about what you're producing. It's about consumption. And to grow in a financialized economy, you need more money supply. You need more M1, M2 money supply. You need more money. You need more loans to be taken out. You need more money to be essentially created to
right.
fund those loans and find their way into that financialized economy to further drive the value of those financial assets up. And we saw that, and we especially saw that in COVID, didn't we? I mean, people thought the world was ending in COVID, but at the same time, trillions of dollars were printed. And while people thought the stock market was going to go down due to the economy being shut down, I mean, that would seem like a normal thing to assume, but that's not what happened, was it, Adam?
No, not at all. I mean,
Surprised a lot of people.
yeah, they say don't fight the Fed.
Yeah.
Don't fight the Fed.
Don't fight the Fed. And what did the Fed do? They printed, is it $3.5 trillion, something along those lines, I believe. And essentially, that money was created. A lot of it was given to BlackRock to basically go buy bonds in the bond market, and then which created profits in the bond market, which would then spill over into the stock market and into other assets and back into housing. Actually, even it just trickled out throughout the whole economy, and essentially was a function of what happens when a large amount of money is created in a very short period of time. like pretty much instantly.
Yep. Yep. Well said.
Yeah.
Well said.
So
Which brings us to kind of this next graph of just where is this at in the world? And
that's a good one.
Sudan being the leader here, lots of conflict there. But I put stars on U.S. At 123, Japan at 235, which is awfully high. Japan's been in tough economic shape for quite a long time.
Mhm. But it's different though. But Japan
it is different. It is quite different.
Who holds Japan's debt primarily? Is it foreigners or locals?
Locals.
Locals. Yeah, it's not quite the situation like in the U.S. where you have a substantial amount of the debt held by foreigners.
That's right.
Yeah.
So Canada at 113, China at 96. What's a major country you don't even see listed on here that I didn't even star? But we talk about them nearly every day.
China? No,
China's on here. Yeah,
China's on there.
Yeah, no, Russia.
Russia. Was Russia not on there? It's kind of hard to tell.
Yeah, I mean, they don't show anything here below 60%. Russia is about 16 to 20% debt to GDP.
Right, because Russia is actually a creditor nation. They're not a deficit nation in terms of trade balances, primarily because they export that much oil.
Right. So as we go from here, this is kind of where we start to really, I mean, the problems we just talked about are massive, but now we start to get an understanding of what it really means. This chart is depicting that red line is the net interest expense on debt. So we can see it climbing and climbing and climbing. And you get to this point where you're at a projected rate. We're in 2025, and I can tell you right now that yes, net interest has superseded Medicaid, it's superseded Medicare, and has now superseded defense spending on military. This is crossing the Rubicon. This is really, one wonders is, can you come back from this? And it really is a big deal because this has not happened before. Right? Am I correct, Peter? This isn't for the US. This has not happened.
It got pretty bad post World War II. Yeah, I'm not saying it was exactly this bad, but it did get quite lousy in World War II,
right,
towards the end.
So you're looking at $1 trillion of interest payments a year expected for the U.S. In 2025, where defense spending is likely going to be somewhere between $850 billion to $962 billion if Trump has his way with kind of getting some extra spending. Yeah, this is a big problem for the U.S. And Ferguson's law says that any great power that spends more on debt service than on their own military defense will not stay great for very long. And if we look at history, which we like history, this has been true of Habsburg Spain, true of the ancient regime of France, true of the Ottoman Empire, true of the British Empire. And the thing that's common with all these empires is they collapsed.
Yeah. You can't forget about the Roman Empire too.
The Roman Empire as well. Yeah. Collapsed.
Yeah. So now we're not saying the U.S. is necessarily going to collapse, at least not as of this moment. But I would say we are saying that this is a problem that needs to be dealt with and rectified. Otherwise, you start to run certain risks.
Which is going to bring us to our point here soon on why is there a major shift happening? These are the pain points. These are the things that are causing major concern and grief. And if nothing's done, bad things will happen. Maybe a collapse could happen.
Yeah.
If this were to continue to extrapolate over the next decade or two.
Yeah. Like I like what you just said there. Why are we even talking about this? And that's because there's a lot of things happening right now, some of which people may not like tariffs, for example. And it's very easy to get mad at tariffs and, put your elbows up or however you want to necessarily look at it. But how did we even get there? Like, why is this even a thing? What's causing it? And that's why we're talking about this, because this is what is causing it and leading us into these events and policies that are being implemented right now that maybe many may not understand fully.
Right.
So,
right.
Yeah. So identify the problems, and then hopefully you can come up with some solutions.
So yeah, and on that, we talked about how much debt there is out there for the U.S. Yep. The average coupon or average weighted debt is somewhere around 3.3. It could probably be a little bit less right now.
Yep.
As they've refinanced over the last little bit. But this is just a graph showing you why you probably hear Bissent and Trump calling for lower interest rates. We know the debt is super high. They have to create a manageable solution. With interest rates still, upward bound, it creates a problem for them.
Yeah, and again, there's probably not one solution for their issues, but one of them is if they can get interest expense down, then that'll reduce that portion of the annual deficit. So
That's
again,
right.
just to reiterate what you said earlier, current interest expense is about $1 trillion a year, which is more than they're spending on the military. So the only way they're going to get that down is either pay down debt or lower interest rates. And we probably know that if they're running a $2 trillion deficit, they're not paying down the debt. So
That's right.
that's just one of the only options they have left.
And that just kind of brings us to, where does the U.S. government get its money? 85% of the revenue comes from Social Security or individual income taxes and Social Security and Medicare taxes. That's 85%.
Mm-hmm. Taxes.
That's taxes. That's right here, corporate taxes, another 9%. Kind of bringing anywhere from 93 to 94% of income collected by the U.S. government. For taxes. And then you have some miscellaneous income here, which would include tariffs, but look how small that is. I mean, where are the main drivers for revenue from taxes?
Now, I have to point out, Adam, maybe we should have a quick discussion because some might look at this and go, what do you mean there's only 9% charged to corporations and the vast majority is charged to essentially people? Why don't they just raise corporate taxes? I'll just summarize really quickly that, people need to understand if you raise corporate taxes, the corporation just raises prices on whatever it is that they're selling you. And that means you pay regardless. So you're either going to pay directly to the government in terms of taxes or corporate tax rates go up and then prices go up, which is probably worse because that creates demand destruction for that product and job losses and things just get worse and exacerbated.
That's right.
Yeah. So there's a reason for that.
And then this is just a graph depicting, obviously the spending, the U.S. government, the revenue that's taken in, and then the deficit that it's expected for 2024. You already mentioned the deficit expected for 2025, but I mean, imagine
it's close to 2.
Yeah, I mean, imagine
I
us going around, say you make $100,000 a year, but you're spending $140,000 on your credit card. You're in debt, and you keep doing that year in, year out. We wouldn't last very long. We would default really fast. We'd be in trouble. You'd be bankrupt. But government's a little different when you can print your own money and your own currency. It's a lot different, right? Yeah. And
they can last a lot longer than we could.
A lot longer.
Yeah,
which kind of highlights why gold did what it did in the era we talked about. Yeah. So I'll stop sharing that for right now. But I mean, overall, the U.S. has a fiscal problem. You can ask yourself what the Treasury can cut out with the annual budget. You can look at that. But at the end of the day, we know the U.S. government's not going to default on their debt. We know that won't happen. Yes, they want interest rates lower.
Nominally. They won't nominally default.
Yeah. Correct.
Because they could always print the money to make the payments.
Correct.
With whatever's left of the currency at that point.
Correct.
Yeah.
Which is like always is really what we expect is you're going to print the money. You're not going to cut entitlements. You're not going to cut Social Security. I don't think Medicare, Medicaid. It's not going to be very popular.
Not if you want to get realected.
Exactly. And you're not going to cut military defense spending in today's environment where we are. That's very important.
That'd be a tough one.
Right.
In this day and age of drone warfare and hypersonic missiles and all this new high tech, AI that's now being incorporated in the military, this will be a very dubious time to cut.
That's right. So, I mean, that leaves you with, very small levels of areas that you could cut. Veterans affairs, no. Transportation infrastructure, no. You need roads. Education, no. So, I mean, the point is there's really no real areas that they can cut meaningfully or cut deep enough to actually make an impact.
Yeah, so maybe fraud. If there's any fraud out there, then they can look at that, but that's still probably not a big number.
And that was really what Doge was looking to do, right? Yeah. Try to find excess spending, but still it's not enough to make a dent to bring down the deficit.
Yeah. And the other thing you got to be careful with cutting in general is if, I'm trying to think of the exact number, but I believe US GDP it's in the teens somewhere. It's maybe 15, 16, 17, 18% of US GDP is actually government spending, meaning that if the US were to radically cut back on government spending, and then they would actually de facto decrease GDP if they're part of that GDP. And if you lower GDP and you still have high levels of debt, your debt to GDP ratio actually goes up, not down.
Yep,
So
gets
it would be
worse.
counterproductive. So making cuts to budgets at this point in time is, let's just say, delicate.
Yeah, at the very least. So I mean, those are really the fiscal issues. Maybe Peter, talk about maybe some of the structural issues that really need to be addressed from the problems we see out there.
Okay. So where do you want to go with that in terms of structure? Like which, there's a million different ways you
Yeah,
can go.
maybe let's just kind of talk about the long end of the bond market right now, because
Yeah.
that's, I mean, that's
Okay.
what
That's what you mean.
Bessent's watching, Trump's watching. That's honestly what we're watching, is kind of what's going on in the bond market.
Yeah. Yeah. So um, this began in earnest probably about 11 years ago, maybe even a bit further with China. But so essentially, there's been a trend, let's call it the last 10 to 15 years, where in general, on net, um, foreigners have been buying less and less US treasuries, and which means they're less and less interested in buying US debt, in period. And if you think about it, that also ties into the whole petrodollar thing we were talking about, where if certain countries do not have to sell their commodities, not just oil is a big one, but obviously other commodities as well, in US dollars, and they're allowed to sell it in other currencies, then whatever proceeds they receive could be in other currencies, like say yuan. And if they're not getting dollars as proceeds, they do not need to necessarily buy U.S. Treasuries or U.S. debt. So demand has been waning. Also, there's been heightened geopolitical risk. So, for example, when Russia entered the Syrian war, I believe that was around 2014. That destabilized things politically quite handily, to the point where Russia reduced their buying in U.S. Treasuries. Even prior to that, China started to reduce their buying of U.S. Treasuries, and in particular, where they reduced their buying primarily was longer bonds as opposed to shorter term bonds. I mean, they still needed some U.S. bonds. They're uncertain about the future. Foreign buyers of U.S. Treasuries are uncertain about the future in terms of what their long term needs are to own U.S. debt. So there's been a less and less demand for bonds that are longer term, which means less and less uncertainty for the U.S. Treasury, because they're simply not able to issue as many longer term bonds, which have guaranteed interest rates for longer term periods of time. And they're forced instead to buy more shorter term bonds, especially since a lot of the bond buying the last number of years has really been more hedge funds located in Cayman or Luxembourg or Ireland or London and so forth.
Yeah.
So it's just changed the makeup of the bond market, and it's created more interest rate uncertainty for the United States.
Yeah, absolutely. And to the degree that, when there is a problem, like we saw even through February through April, the long end of the bond market, kind of freaked out, right? And
Yeah.
it really, that's what
Yeah.
really caused Trump and them to, take a step back and have to
Back up a
fix
bit.
things,
Yeah.
right?
Yeah, because they came out pretty hard, in February.
Saying we're willing to take some pain.
Yeah. Yeah, and they kind of backed off a bit,
Yeah.
right in April, because they started to lose the price or the interest rate on those longer term bonds.
Rates were climbing when they initially went down for about a week, and then they spiked back up. And rates up, bonds down. That's not good. That's not good for many institutions holding longer term bonds in the U.S.
Or the government. I mean, what did we just say? For the U.S. Treasury, they need to get rates down, not up. Otherwise, they're going to be refinancing this $37 trillion of debt at a higher rate, which would make their fiscal deficit even worse, because it would further increase interest payments. They need to go the other way. They need to get those rates down.
Yeah. So long story short, they have a really hard time right now thinking that they control the long end of the curve, where they think that they can control it, and to some degree it's true, is on the short end, and that's the overnight rate, which they are, trying to get down with Powell, a lot, 8 months ago, really.
Yeah. Hence the almost war of words, if you want to call it, between Trump versus Powell.
Yeah. And maybe the other structural thing I'll kind of just maybe bring up, is we've talked about manufacturing leaving, and there's a big problem and a byproduct of that. It's said that the military backs the U.S. dollar, right?
Yeah. Yeah.
Well, who backs the U.S. military? Usually it's the manufacturing base. Where is our manufacturing base right now?
Well, yeah, that's right, Adam. Where did our manufacturing base go?
That's right.
And that, so maybe in the last few decades, the U.S. Had enough of a manufacturing base left on the military side to fight small wars and against smaller foes, and that would include even Afghanistan or Iraq or Somalia or these countries that were certainly like on a lower playing field than what the U.S. military was at. But Adam, let me ask you, what happened now in this Ukraine proxy war that we've seen the last couple of years?
Yeah,
A real war.
Yeah. I mean, well, Secretary General of NATO, Mark, I think it's Rutte. Is that how you say his last name?
I'm not sure. It's either Rudd or Rutte.
Rudd or Rutte.
Yeah.
I mean, he's the one that declared Russia outproduced all of NATO 4-1.
Mm-hmm.
And NATO is a 25
Incredible.
times bigger as a collective economy than Russia. So you're 1/25th the size economically,
Yep.
but yet you outproduce 4 times the amount of military armaments.
How does that happen?
How does that happen?
It's like, what?
Yeah. And I mean, and so, Russia and China have been focused on industrial production and manufacturing. And that is the answer. And
they
we
have
have
factories.
Not.
They have operating factories.
And that is really one of the also major problems in the U.S. It's a national security issue that, if you're going to enter a longer sustained war right now, the U.S. knows that they won't win. Sadly enough,
be challenged.
Or be very, very challenged. I mean, if you're going to have a longer sustained war against Russia or China, what have you.
Yeah, against a formidable foe, like a country with call it like a real global army, like China, like Russia, like the U.S. Would have. It was a real wake up call, wasn't it? This Ukraine war. I mean, it certainly has dragged on a lot longer than what many people have thought. Which has required a lot more munitions to be produced than maybe what a lot of people thought. And we clearly don't have any more. We used to back in the 40s, for example. We used to have what it takes to make tanks and planes and bombs, and it's not that we don't right now. We just don't necessarily en masse at the level of capacity that's required to fight a serious war.
Yeah. No, well said.
So I don't know about you, but I think that's a problem that needs to be fixed.
Yeah, no, I mean, the Pentagon's been saying it for years. They thought by 2021, if you didn't do something, you're going to be way too late. And here we are in 2025. And so we'll see. I mean, but obviously, if we're talking about what the problems the U.S. is facing, this is one of the largest ones. I mean, with the debt, from what we see, from policy and from what's being said, it's indicating to us that they're taking this very seriously, and hence where this new monetary system is starting to take shape.
Yeah. So maybe, Adam, I don't know, maybe you want to talk about that right now. I mean, we just been talking about the previous monetary system. We talked about the challenges that the U.S. is facing as a result. And there are many, and we obviously did not cover all the challenges. I know one of the things we missed was when the United States froze Russian assets, to help with the Ukraine war, as an example. A lot of people cheered that on as, it's basically saying, oh, that's great, freeze those Russian assets and so forth. But what people need to understand is when you do that, it's kind of like stealing, in a way.
Oh, it's theft.
Yeah. And while we potentially may cheer that on, others are looking very unfavorably on that, saying, you just stole from those guys, and so if you stole from them, then how do I know I can trust you with my stuff that I have with you?
That's right. I mean, unprecedented, right? I mean, the U.S. has a responsibility as a reserve currency to maintain the credibility of that dollar.
Yeah, so that didn't help. That didn't help with this whole crisis of confidence, so to speak. So this is all really what this is setting the stage for, is really potentially a new monetary system. And we don't know exactly what it's going to be called, or how the history book's going to be written, but something is inbound. So, there's writing on the wall that changes, are coming. So, Adam, do you want to talk a little bit about maybe
Yeah.
possibly some aspects of what we may call a new monetary system and how that may look?
Yeah, well, maybe let me just simply start with, this has kind of actually been happening in the background for a while. You briefly alluded to it, but really 11 years ago, the US dollar has already kind of been starting to get replaced at the central bank level, right?
Yes,
Where you talk about, you're seeing less foreign buyers of treasuries on net, meaning they're buying, while still buying, they're buying less and they're
buying less.
maturing and they're buying less and they're buying less. And so their treasury reserves have been declining. And I'll share my screen here to kind of just emphasize this point. Is while these have been declining, $200 to $300 billion, if you will, treasury ownership outside of the United States, in that same timeline, we've seen $600 to $700 billion worth of gold added to balance sheets. That's an important clue to start with, wouldn't you say?
Yeah, and just almost to kind of bring this home to, uh, in almost comparison to what investors out there have. Like, if you're an investor, you can probably talk all day long about that you own Nvidia or you own this bank stock and you own, Microsoft and you own Apple. But what do central banks own? And because that's important because these are the central banks that govern all other banks, and surely what they're buying on their balance sheets matters. And like a long time ago, of course, it was gold, and then it went from gold to dollars, and now what does that chart tell you, Adam? It's reversed again, hasn't it?
Yeah, no, it's definitely saying gold is the favored reserve asset over U.S.
Yeah,
treasuries.
yeah, yeah, and and
100%.
and that's been, as you stated, that's been going on for a few years now, hasn't it? So
Well, the trend has been,
the
you can see
trend,
the lines. You can
yeah,
see the lines converging, and you get to the point where it happens. And, you have to ask yourself why. And a lot of the conversation we've just had is kind of indicating why. And so the next question is what next, right?
yeah,
And
and
that's,
also
that's,
back to recency bias. I mean, like people that have only been investing, say, for the last 25 years, only
mhm.
know a world where it's treasuries in the U.S. dollar that mattered the most. But if you go back further, no, it was the other way around, and now it looks like it's flipping back to more like where it was, where
Right.
gold dominates.
And yeah, and so next, I guess I would kind of suggest where we're going. Main theme, and it's being expressed by the Trump administration quite heavily, is around devaluing the U.S. dollar
Yes,
relative to other currencies, especially the yuan. I mean, and we talked about that briefly. I mean, all to try to rebalance global trade and the massive trade deficit that the U.S. has with the world. I mean, trade deficit meaning that the U.S. consumes so much more than it exports with nearly every country out there.
yes.
So if we touched on it, if you have a weaker U.S. dollar, that makes U.S. goods more attractive to foreign countries because they're cheaper to buy. I mean, it's pretty simple, right?
It's fairly simple, and essentially, if the U.S. doesn't like where they're currently at today in terms of their trade deficit, how do you fix that? Well, basically, you go in reverse. You just reverse exactly what happened. So instead of having a strong dollar, which forces manufacturing jobs overseas, forces the dollar up, other currencies down, you reverse that. If you go dollar down versus other currencies, our output becomes cheaper. It now becomes easier to bring back that manufacturing, and also industrial production.
Yeah. And I got
Yeah,
a quick clip here directly from Trump on this. Can you see that?
I can see it. Yeah,
Okay. Let's just 20 seconds.
So when we have a strong dollar, one thing happens, it sounds good. But you don't do any tourism, you can't sell factories, you can't sell trucks, you can't sell anything. It is good for inflation. That's about it. And we have no inflation. We replace it. But it's an interesting question.
there you have it.
So, I'll just kind of, I thought that was important context. A lot of people may not understand. I mean, obviously, the way global trade works. I mean, strong currencies, weak currencies.
Mm-hmm.
What does a
that
tariff
mean?
do? What does a tariff do? What does it not do? These are very important concepts, right? That govern the way the world works. I mean, it just makes economical sense that, why would you buy something for, $10 when you can buy it for $1?
That's right. Yeah.
But when you can level the playing field, things start to even out a little bit. The U.S., to some degree, at this point now, feels like they're a bit on the losing end, despite maybe reaping a handful of benefits from the system that we've been in. One could say it no longer serves U.S. interests to run the same system.
Yeah. So you mentioned on the losing end, Adam. Who's on the losing end and who's on the winning end in this past system that we've had? Wall Street, Main Street. So
yeah. I mean, it's exactly it. Wall Street has done very well, right? Stocks.
Sure.
If you own financial assets, you own real estate, you participated strongly in this growth. If you have not, you've seen your jobs go to China or to overseas, and you've had to find ways to make ends meet or make it work. You didn't necessarily participate. Yeah, this is Main Street. This is the main everyday person that hasn't been able to participate. And Trump has said that, and Bissett, they've said Main Street needs to do better. They've been, and as to your point, you mentioned this earlier, Peter, middle class America has been hollowed out.
Yeah. Ohio, like you said, and the whole Rust Belt. I mean, it's hollowed out, and they're just not producing enough really to garner, real wealth, which can then pay real taxes as well. So.
So I mean, all of this could kind of say that, the petrodollar system ending, dollar devaluing to become more competitive, the US dollar hegemony or, as a main reserve asset, as we can see by that chart we just showed, it's appearing to come to an end. Central banks are valuing gold more than US dollars. That's not an opinion, that's a fact. And why would maybe central banks around the world want to hold dollars at this point anyway? You talked about the uncertainty going on with the US dollar. And certainly, that is all around decreasing in purchasing power as well.
Yeah. And so you mentioned about the US dollar coming down. So now I would like to state that it doesn't necessarily mean it's going to crash. It doesn't mean that this is an end of the world type event and we're not really trying to stoke fears. It just means that the system is changing and adapting and we need to adapt with it. And for many Americans, including the current administration, they may want some of this to happen. They may want the US dollar to come down so they can bring back more manufacturing jobs. And stabilize Main Street. It doesn't mean it's going to crash. It just means it's going to come, that there might be an interest for it to actually come down.
So, yeah. If it happens too fast, obviously that would be a shock.
Yeah.
But I mean, if the dollar relative to other currencies slowly trends downward, I mean, I think that's the glide path that they're looking for. And Trump said it in terms of, people overseas don't want to buy our tractors. They don't want to buy our trucks. They don't want to buy our goods because they're too costly. What does it take for them to buy a US dollar in China? You fast forward and you devalue what that cost of that US dollar is, it becomes more palatable.
But essentially they have to now incentivize somehow, some way, that manufacturing to return to the United States to help reduce some of these deficits. So obviously tariffs then play a role in that too.
Yeah.
We like some, but
yeah. I mean, at this point, right? It's kind of a tool for national interest.
Yeah.
So, which kind of brings me to kind of like another point, maybe, and this is pretty visual as well. We just looked at this cross of central banks and gold and foreign treasuries. But if I go to the next one, this is interesting. You read that out, Peter.
The golden rule of negotiating and success. He who has the gold makes the rules. Thank you.
It's kind of an interesting time tweet on April 20th.
Cryptic in a way, right?
Pretty cryptic. Not to say that, that is the end all be all. But pairing that with something like this is the purchasing power of a dollar from 1913 until today in 2025.
Yeah.
I think this graph is going to surprise a lot of people.
Yeah. What's it worth today? What does that say? Is that 3 cents?
Yeah, 3 cents.
3 cents. So I suppose hiding dollars under your mattress for long periods of time, probably not a winning strategy, is it, Adam?
Not at all. No, I don't know.
Yeah.
That's bad.
But now, if you had that same money in gold, as an example, you can take that chart and basically invert it.
Exactly.
Yeah.
Exactly.
Yeah,
Exactly.
It just went up, substantially over that period of time. And in fact, actually, the rate of growth on gold, this may surprise a lot of people, since 1971, since Nixon closed the gold window in 71 till today, the rate of growth on gold, has exceeded the price return of the Standard & Poor's 500 index. Not including dividends. Now, if you go from 2000 till today, the return on gold has far exceeded the return of the Standard & Poor's 500, which has actually a lot to do, really, with the devaluation of the dollar.
It's basically they're inversely correlated.
Inversely correlated, yeah, exactly.
I'll just share a screen on that just because I have it. This is gold since 2000.
Yeah, wow.
Somewhere around
What does that say, Adam? 1,081% rate of return.
Sounds pretty juicy. Let's just bring up the.
That hasn't even been that long, really. That's 25 years.
Let's bring up the total return index for the S&P 500, which is including dividends.
Okay.
Let's go with that next.
Yeah, pretty good. 600%, nothing to sneeze at. Whoa, still.
Right?
Yeah.
And I think these are things that people don't know.
And that's total return.
Again. Total return with dividends.
With dividends.
Here's
so much for dividends.
Without dividends.
Right. Which actually shows you how much dividends do matter in that equation.
They do matter. They do matter. And then if I were to bring in the TSX here in Canada throughout that time frame, pretty crazy, huh?
That's a 228?
Yeah, 228 is a TSX.
Okay. So much for having all of your money in Canadian stocks. From a portfolio perspective.
Exactly. Yeah. So what is your game plan? What does your playbook look like? Hopefully it wasn't relying entirely on Canada.
Yeah. And once again, we're not saying that, own this, don't own that, don't own this. We're saying in a properly constructed portfolio, you probably want to own bits and pieces of all of it, especially at different times. Maybe not all the time, but at different times you do want to have exposure, or at least it should be a tool in your toolbox. And if it's not, like say gold, for example, is not a tool in your toolbox, with those rates of return, you have to ask yourself, why not at the end of the day?
Yeah.
Clearly
So Peter,
it's outperformed.
I mean, we hit some good points here. In terms of this new monetary system, there's been a lot of talk and a lot of craze on Bitcoin, crypto assets. There's been, Trump and his administration, passing the Genius and Clarity Act, which was directly supporting, tools within the crypto space, and
legitimizing it.
Yeah, exactly. And not only that, saying that Bitcoin will be a reserve asset, and they're looking at ways of purchasing Bitcoin.
Mm-hmm.
Maybe just quickly touch on this because this is transformative as well.
Yeah. So again, what is a reserve asset? And that's simply, what either a central bank or a Treasury Department, like the U.S. Treasury, would keep. What kind of assets do they keep on reserve to obviously maintain financial stability and purchasing power, well into the future? So again, gold still is a reserve asset, has always been, I believe, a reserve asset. And probably the main reason for that is it's universally accepted all across the world, and has been for, I believe, 6,000 years, which is a very long time. And it preserves purchasing power, with those types of returns. Certainly, if you have an ounce of gold today, it's, you could almost, nothing in life is guaranteed, but there's a high degree of confidence that in the long run, it's going to keep up, with inflation and so forth. But now they're expanding, what they call a reserve asset. It's not just gold. It's not just treasuries or currencies. It's many assets. Actually, it's not just one, but it now includes Bitcoin. So Bitcoin that the U.S. government currently holds, all of which, at least for now, has been accumulated from seizure. Not that they bought it, they seized it. Those are seized assets that they took from, criminals, or maybe people who didn't pay their taxes. Who knows exactly where they got it from? But that is now actually labeled as a reserve asset. What you touched on there is that they're actually talking about purposefully, maybe in the future, buying additional Bitcoin, i.e. issuing debt probably, or finding ways to buy Bitcoin and keeping that on as a reserve asset as well. For the same types of reasons, Namely, maybe Bitcoin also has a tendency to preserve its purchasing power over time, and then some.
Yeah, despite being volatile, it's
despite the volatility.
That's right.
Yeah, yeah. Now Bitcoin's a lot more volatile than gold. Let's be honest here. But but as well as gold has done, if you look at the rate of return, say on Bitcoin versus gold versus the stock market, I mean, basically Bitcoin has outperformed everything, and by a long shot too. It hasn't even been close.
Yep. Yeah, and so maybe next we'll just touch on in terms of new monetary system. You already mentioned that China and other nations like India, they have been trading commodities, energy specifically, in their own currencies for several years now. They've these BRICS nations have created their own payment processing system, if you will, not settled directly in local currency, but actually settled in gold with vaults across the belt there. So I think that's an important lesson to take here from what these nations are saying, and in terms of what they view global trade looking like. This system has been tested, and they have been moving outside of the US dollar for some time now to some degree.
Yeah, this is very interesting now. So what another reason why central banks around the world have been accumulating gold in earnest over the last number of years is because there are some countries, especially the BRICS nations, as you mentioned, they're trying to move more towards a system of trade that settles trade imbalances with gold versus dollars. And historically, imbalances were settled with dollars, i.e., if at the end of the day, China sent the U.S. more goods and the U.S. sent to China, and I believe on average, that's a trade deficit to the U.S. of something like $700 billion a year, 700, maybe $800 billion a year, something like that. All that means is that at the end of the year, the U.S. would write a check to the Chinese for $700 or $800 billion to settle those trade deficits. But they don't really want that money anymore. They don't really want those dollars anymore that they now have to recycle back into U.S. debt. So what they're saying is that, if you owe us money, we just want you to pay us in gold. But which is how it's been done in the past anyways. But that's very difficult to necessarily move that gold around the world because it's heavy and it's kind of risky sometimes to move. So they're developing essentially payment systems where these trade balances and imbalances can be settled in gold without actually physically shipping the gold. And one such system is called M-Bridge, like Money Bridge. And it's a system that the Chinese co-developed with the Bank of International Settlements in Basel, Switzerland, actually, although the BIS did drop out of that project about a year ago, I believe. But essentially, they're setting up these depositories of gold all over the world, which will hold gold as security. And then the trade deficits will be settled notionally through this electronic payment system secured by gold that's basically held at these depositories. So it's not fully necessarily active right now, but as you mentioned, it's in the testing phase, and it does seem to be the direction that they want to move to. At least some countries, not necessarily all countries, but the BRICS nations, for example, indeed are looking to move in that direction.
Right. And I mean, if you got to ask yourself, what is 2 + 2 + 2, right?
Yeah.
2, 4, 6. I mean, we're looking at central banks. What are they doing? They're buying and owning more gold.
Yeah.
You're looking at why? Yeah. And you're looking at, okay, global trade is being tested out and settled in other means other than US dollars. Where are we going here? And that's where you got to put the clues here together and kind of start to look at, what is the world becoming? Like we talked about earlier, where are we going? Because certainly there is a change at hand.
Yeah. But as you mentioned before, with the some of the acts that are being put through right now, the U.S. is not going to sit idly by here. Where there's a one action, there's a reaction. So essentially, the future is not written in stone. We don't know for sure what's going to happen, but these are some of the plays on a chessboard, basically. Being made. You have the U.S. issuing the Genius Act and the Clarity Act to not only regulate cryptocurrencies, but also to find ways to essentially funnel certain assets from cryptocurrencies into U.S. debt. But then you have the Chinese and other nations, setting up this bridge payment system, kind of going a different route. And so I guess we'll have to see who wins or what the final solution is.
Yeah. I mean, and I guess if you really look at it, I mean, trading oil in U.S. dollars, granted, prices of oil have varied from time to time, but, the U.S. dollar, as we just showed, has only gotten weaker over time and how many barrels of oil it'll purchase for just that $1.
Well, that's important.
Right.
Yeah, talk a little bit more about that.
That's where, the inverse
Gold for oil.
is true. Gold for oil, and in 2005, say you could buy eight barrels of oil per ounce of gold.
Right. Not much.
Sure, maybe gold was trading around 50, 60 bucks a barrel. Right. But if you look at where you are today, you can buy nearly 55 barrels of oil per ounce of gold. That's 7x.
7x.
That sounds pretty good if you're a sovereign nation trying to secure your energy future.
Absolutely. Like if you're president or a prime minister of some country or the head of a central bank, and it's very, very, very important, especially if you're not an oil producing nation. Like you don't produce oil, you consume oil, and you need to secure that oil way out into the future. So your children will have oil and your grandchildren will have oil. Buy gold, and today 1 ounce of gold will buy 55 barrels of oil. What's it going to be in 10 years or 20 years? 100 barrels, 200 barrels, 300 barrels?
And this is, I think the kind of the main point here is that if this is where the system's going, that's what we'll see. We'll see a continued increase in the amount of energy you can get per ounce of gold. When in fact, gold almost measures energy by itself anyway.
It's almost like a store of energy.
That's right.
Yeah.
That's right.
Yeah. And actually what makes it a good store of energy is because it's not used for almost anything else. You're not going to store it in corn because you're going to want to eat it. And you're not going to store it in natural gas because you're going to want to burn it. You want to store it in something that really has little other use other than looking, pretty and shiny and so forth.
Yeah. And I couldn't help myself but think to this point of most people may not understand what gold does, what it's used for, or maybe even say it's not used for anything, doesn't pay dividends. And to some degree, they're right. And to your point, Peter, on recency bias, gold doesn't do anything until it does.
That's right.
Which is you get to a point where we just showed all these charts on, what is the debt situation? What is the debt to GDP ratio? What are the things going on fiscally that are creating major concerns for the U.S.? Well, I mean, gold in the long debt cycle is used for something. It's just you haven't seen it in a long time. Gold is used to recapitalize balance sheets, erase debt.
It can erase debt. So how could it erase debt potentially?
Well, there's a few angles we can go here. Obviously, you already mentioned where we could be in the first inning of a 10-inning baseball game.
That's right, early.
But you could get there even quicker from something even like a gold reset, which is spelled out in the manual. At the Treasury.
The Treasury actually has a manual on this, don't they? Yeah,
they do.
Yeah, I mean, like, what if they have 8,000 tons of gold? Why not just increase that 8,000 tons of gold at a higher price, and then, have more money that you can create essentially out of thin air, with a higher price of gold based on the gold you already own, and use that potentially to pay down debt or pay deficits for a few years.
But if we parallel this to maybe 1971 to 1980, as we kind of did already, gold being suppressed, what did it do? It went off like a rocket ship. It tried to find a natural equilibrium for where dollar devaluation, if you will, has gone, how much money supply is out there. Maybe an important point we didn't hit during the petrodollar system and related to gold and where gold's prices relatively have been suppressed is from kind of the paper gold market that's been centered out of London. And if you will, right, I mean, if you're a petrodollar system, you want to issue dollars to the rest of the world. you want the dollar to be the reserve asset of the world.
King.
King, that means you don't want gold to be king, right?
No.
Exactly. So paper futures on unallocated gold are a way to kind of keep gold suppressed and keep
put a
gold
lid on
quiet.
it, basically.
Put a lid on it.
Yeah.
And you now get to this point where the system is now ended and gold has been suppressed, much like it was before. It's not crazy to think that, once again, we're in the first inning.
No one should be surprised at the rapid rise in the price of gold over the last number of months and even years. No one at this point in time.
Well, that brings us really to, Peter, this is a financial playbook. We're athletes, professionals in the former rights.
Mm-hmm.
What plays do you call here? How do you build a game plan? How do you build a portfolio for maybe what we see coming? What do you do?
Shockingly, it's a lot simpler than most people think. Like a lot of these problems seem large, they seem colossal, they seem just scary or insurmountable, and they're not really. But what could lead you to that conclusion is if you have a very small toolbox or you have very limited plays in your playbook. Let's say your playbook is like 1 page thick. That's it, and there's only 2 plays you can call. And if neither are working, then, well, you're not going to do too well. So could you imagine a defensive playbook, for example, that only has 2 plays, or an offensive playbook with 2 plays? It wouldn't work too well. But yet, wait a minute, that's kind of what most investors have, isn't it?
Yes.
If you look at the average investor's playbook, what are the 2 plays that they have typically in there, or maybe 3? What do you think?
Well, yeah, I mean, you're going to have most investors out there, especially those nearing retirements, trying to secure their financial futures, balanced portfolio of equities and bonds, and
maybe some cash,
maybe some cash. And if you're been lucky enough, maybe you have a little bit of alternative assets, maybe 5%.
Sure,
maybe.
Yeah. And some people, I'd say the majority don't.
Majority do not.
Yeah. But certainly, though, a lot of the wealthier individuals out there would have some alternative assets. But majority would typically have stocks, bonds, maybe some cash. It's a pretty thin playbook, isn't it?
Extremely thin, especially when you talk about, what we just mentioned, cycles. Cycles that create and destroy wealth on either end.
Yeah, like kind of what happened in 2022, right? So what happened in 2022 right after COVID? I mean, we had interest rates at record low levels, right?
That's right.
And then where was inflation?
Running 8% plus on reported numbers, but probably higher than that from what we all know what the grocery store bills look like.
Yeah. So let me get this straight. You had record low interest rates, record high inflation. Under that playbook, what do you think central banks are most likely to do under that scenario to interest rates? What are they going to do to rates during that time?
Well, I mean, that's why history is important. Rates are going up, and they're going to probably go up pretty fast.
Sure, as the sun's coming up in the morning, those rates are going up.
And then you have to ask yourself, okay, well, if rates go up, what do we know about bonds, right?
The price goes where? Inverse. Down.
That's right, inverse related. So interest rates up, bonds down. Many people's wealth was pretty well destroyed, and bonds really have not recovered in the last 5 years.
Sure.
From this rate cycle, and that's maybe what we're alluding to is a problem of maybe a very thin play call sheet.
Yeah. So that 60-40 balanced playbook, the 40 in the bonds went down during 2022. But wait a minute, what was happening to stocks at the same time? So if interest rates are going up that aggressively, what does that do to corporate America and stocks? What does that do to the price of stocks?
That's right. Everything goes down. I mean, you're looking at all these companies. There's now less consumerism, less demand, layoffs. I mean,
yeah. But what do you mean both go down? How can both go down? I thought the whole point of a 60-40 portfolio was if the stocks go down, the bonds go up, and if the bonds go down, the stocks go up. Wasn't it?
That's the way it's been for a long time. Yeah. Hence the recency bias.
Yeah, well, that's what if you had recency bias, that's what you would think. But wait a minute, that balanced portfolio, stocks lost money, bonds lost money. But you literally have 2 or 3 plays in that playbook. So, what could be possibly a very basic solution as well? Increase the size of your playbook, like have more plays, have more tools in your toolbox that you can utilize. So what happened to gold during that time? As an example, I think it did
Yeah,
okay.
well, yeah, we just showed the chart, but yeah, no, it did exceptionally well.
Yeah, it did okay, and there might have been some certainly some other assets, that might have also done okay as well, but it wasn't literally just stocks or just bonds. You have to branch out. So maybe Adam, if you don't mind, just talk about some of the other asset classes that one can invest in.
Yeah, I mean, you know, uh, gold and silver, precious metals would be one. I
Sure.
mean, could be considered a commodity, right? So
Hmm.
commodities,
Precious metal commodity. Yeah.
precious metal commodity.
Yeah.
I mean, specifically one that we would have exposure to through 2022 in an inflationary cycle was oil.
Hmm.
You look at many of the oil companies were making money hand over fist, and that was a great place to have um, some asset allocation during that time. Simply, selling bonds was the right choice which we made, and holding more cash. But other than that, you're looking at now alternative assets. And what are alternative assets? Well, they're assets that behave differently than a stock or a bond, or could be private equity, private debt.
Yeah.
Um,
It's a big
could be,
catch-all.
yeah, a big catch-all. So could be a hedge
Yeah.
fund, could
Hmm.
be, futures, derivatives, could be, something simple as Bitcoin. But these are all other kinds of assets that you can own that are not the same. And I think that's the important part, is they're not the same. They're different than stocks and bonds.
You could have bought Bitcoin quite cheap during that time, couldn't you?
Yeah.
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 Yeah. And it's gone up significantly over and over on itself, since 2022. Now, Adam, if I were to talk about if you have multiple plays in that playbook, which we call in our industry, we call that different asset classes, essentially not having just two or three asset classes, but having, 4, 5, 6, 7, having multiple asset classes in that portfolio. If I were to talk correlation of those asset classes to each other, what does that mean for both rates of return and also risk level as measured by volatility, or what we would call standard deviation?
Yeah, I mean, to that point, the entire reason why we look for other asset classes other than just stocks and bonds is to do exactly kind of what you talked about in your question, is lower correlation throughout the entire portfolio. In the falling interest rate cycle we've seen over the last 20 years, or really since 1980s, you really see correlation between fixed income, bonds, and stocks getting closer and closer and closer together, where they're not, what they used to be in terms of how different they are and how
Yeah.
different they behave.
Yeah.
And we
Looking
saw that in
more like
2022.
yeah, yeah,
So, trying to find asset classes that are truly different in the way they behave in the market. And what that does is it creates less volatility through the portfolio that doesn't necessarily sacrifice returns, but we create a return profile in essence that has less, violent ups and downs, right? So as opposed to a roller coaster going on your way up, maybe more gentle waves on the way up. And that's a simple byproduct of, what do you own? What do you own in your portfolio? What plays are you calling, and why?
and why? Yeah, and of course, this is what we do for a living. So to us, this is just what we do every single day. And after, let's see, for me, it's now 28 years. So after a while, you just kind of get good at it. You've seen everything kind of repeat itself over and over again. And then you, again, don't fall to recency bias, read some history books, go a little bit further back, even before you were born, to know what occurred under in certain environments. So, but the net result is, what you want decent returns over time, but you would ideally like that with less volatility, because with less volatility, a couple things. Number one, you keep people invested for longer, because they don't get as worried or as scared, so to speak. And it's a more comfortable ride. Not only that, if I'll just take an exaggerated example, but a lot of people already know this. But if you start with $1,000, and if you lose 50%, now you have $500. And to get back to $1,000 where you started, it's not good enough just to make 50% back, because that only gets you back to 750. To get back to 1,000, you need to get 100% rate of return at that point in time, which is huge. So the moral of that story is, if you want to make money, you should start by trying not to actually lose money in the first place, because then you got to make it back. And that's often tough.
Yeah. Well said.
Yeah.
Well said.
Yeah. So it's pretty good, Adam, I think. I mean, at the end of the day, while people can do some of this on their own, obviously we're professionals, and this is our business, and this is what we do, all day and every day. But ultimately, it's structure these types of portfolios that are just more resilient in multiple market cycles over time, and that are a little bit more resilient to weather storms as they occur. And we do think that we're going into some sort of I don't know if storm is the right word, but let's just call it a shift or a change. And we need to be adaptive. And not reactive necessarily, but adaptive, and try to see these call the right plays as we see things evolve over time.
Yeah, no, without a doubt. I mean, when you have multi-asset classes that you can invest in, all of a sudden now you can kind of say, oh, how do we want to split up the pie? I mean, we have 5, 6 asset classes maybe we want to pick from, as opposed to 2 or 3. You have a lot more levers to pull. You have a lot more areas to look at that may be, catching your attention, that will provide value on the upside, and obviously protect downside risks in market cycles. So, once again, having more plays is helpful, and our job is to be able to help call the right plays at the right times, and understand how to shift assets in this, ever changing time.
Sure. Yeah. So what do you think, Adam? Is this the part of the podcast where we ask people to like and subscribe? I always wanted to say that.
I know. We probably should have started with that.
Yeah, we probably should have. Yeah. But
but this is really going to be the first one of many. If you have specific questions on finance related topics, anything related to anything we talk about, anything you think about, put it down there so we can see it, and we'll try to answer them. But we'll have a lot of good stuff coming your way, and most importantly, we do want to know what you want to hear, so we can create that kind of content that you're looking for. So yeah.
Well said, Adam. And on that note, to all the viewers out there, please like and subscribe. And if you liked the content you've heard today, please forward it on to your friends as well.
Perfect. All right. Well, until next time, see you guys.
Yeah. See you guys. Thanks, Adam.